Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focusing on the S&P 500. We are seeing some pretty big developments on the charts across the board. On pretty much any indicator that we're looking at, we're seeing some big movements on the market. So this is probably going to be one of the most important videos that we've filmed in quite some time. And if you don't agree with anything in this video, make sure to tell us in the comments down below. We appreciate any feedback. We appreciate any constructive criticism that you guys have, and we will be answering comments. Now, if you are new here, make sure to smash that subscribe button because I'll be here helping you navigate through this crazy market every step of the way. So now, without further ado, let's get right into it. So we're going to start off with a quick technical analysis for the S&P 500. What's going on this chart? We had a pretty big sell-off on Friday here. So how are we going to be adapting to this coming week? And is this sell-off just the beginning of a much larger move down, or is this actually a buying opportunity? Back here in this move down, we talked about this sell-off as the markets were approaching this support level, and we said it was a perfect buying opportunity. We had no warning signals trigger on any of our indicators suggesting that this was not the beginning of a much larger move down. But as I'm going to show you in this video, this move down tells a different story right now. By the way, if you learn something new from this video, if you enjoy it, make sure to click on the like button and share it with your friends, share it on social media. We really want as many people to see it as possible because some of the developments that we're anticipating right now may catch a lot of investors off guard. So now just the recap of what's going on the S&P 500. We've had a massively bullish structure on the S&P 500 for months now. This has been such a powerful rally. No rally in history, I believe, has matched the kind of gains we saw throughout the end of 2020 and the beginning of 2021. Just a huge risk on move fueled by easy monetary policy. So if we take a step back from this chart and take a look at the longer term picture, these were the long-term levels that we were looking at, this huge long-term price channel. And you can see right here in March 2020, we broke out above this massive level of resistance. And that breakout was fueled by this huge easy money risk on rally that we saw on the equity markets. And we said that unless anything changes in the macro environment, we continue to expect higher highs because this breakout right here is a very bullish development. And instead of expecting a short-term correction and continuing to trade within this range, this breakout tells us that we can expect higher highs and that we can actually backtest this level and resume higher. But that is if nothing changes. And as I'm about to show you, things have changed over the past few days that are suggesting we're not going to be seeing much higher highs on the S&P 500, at least in the short term. Now, quickly looking at this 8-hour chart of the S&P 500, we've obviously had some deterioration in the technicals. We broke down below this level after rejecting off that price channel resistance. This is a level that we've been looking at for weeks, expecting it to act as resistance. Go and watch the last video we made on the stock market. We said that we expect this to act as resistance and see some short-term volatility. And the very same day where the market was actually top, on the 14th of June 2021, we posted this article on our website at gameoftrades.net for our members, giving a full evaluation of the equity market health and talking about the probability of a short-term correction that was rising. So we obviously had a trade from a few weeks ago where we bought that dip. Taking partial profits at that resistance level was a very good idea. But now what's going to happen next? And that's exactly what I want to focus on. We're going to take a look at quite a few indicators in this video, but I just want you guys to remember this chart. We sold off very quickly on Friday here, breaking through that zone of support, that price channel support here that we've been looking at for months. This level of support corresponding to this parallel line that we got from this long-term level right here, really a breakdown. This is just some short-term volatility that was 100% to be expected after this kind of move up in the markets. Where the technicals really begin to get damaged is when the markets correct past this level right here. This is what everyone is watching, this trend line. If it gets broken, we're looking at a 5, 10, maybe even 15% correction. And what worries me the most about this type of breakdown here, this type of big breakdown, is that we currently have QE. We have quantitative easing, and the general consensus is that with QE, the markets don't go down. So if we suddenly start to see a larger correction despite QE purchases, suddenly that consensus is going to be gone and we may see some panic selling ahead. But for now, that has not happened yet. But let's look at the charts to see if that's actually a possibility or even a probability. And we're going to begin with this move on the dollar. This is by far the biggest development that caught our eye over the past few trading sessions. This move is showing an incredible amount of momentum. This is a massively bullish development for DXY. Now look at this RSI reading. We're massively overbought. It's an 88-point reading on the RSI here. Now obviously that's overbought in the short term. We might see a small pullback, but what this tells us is that this is a move with massive momentum. What we expected from that 89-point level is a small bounce, a weak bounce to rally to the 91-point level. Then we reverse and continue the bear market, continuing the risk on environment, the dollar bear environment that we've had since the beginning of the pandemic, where we started to see that easy monetary policy that has pushed asset classes higher. That has been in large part due to the weak dollar environment. And if you've been following this channel over the past few months, you'll know that we expected this environment to continue for quite some time. But the most important part of trading and investing is to be flexible and to keep an open mind. And this move right here is telling us that this may not just be a counter trend rally, that this might actually be the beginning of a much larger move up in the dollar. Now, what we're watching here is this resistance level at 92.75 points. We could still very well be in a weak dollar environment. We just need to see the dollar stay below this level. So if we see a correction at the beginning of the week, then a rally, and then we reject off that level, that would be good news for assets in general, and we continue the dollar bear market. But with the current momentum we're seeing on the dollar, it's telling us we might not see that type of move, and we might actually break this 92.75 level, which would strongly increase the odds of more upside on the dollar in the short intermediate term, which would cause turbulence in pretty much every asset class. Now, we wanted to see if there was any other moment where we had such an overextended RSI reading at the beginning of a move up in the dollar. So let's put a horizontal line on this reading and see if we've ever had an initial move on the dollar like this with this much momentum. Let's zoom out. You can see in 2020, we'd never reached that line on the RSI. To get a reading like this, I believe you have to go back to 2015. And this reading right here in 2015 was at the very end of a large move. So that doesn't look much like what we're seeing in 2020. We have to actually go back to 2008, August 2008, to see an RSI reading of similar magnitude on the dollar after an extended downtrend on the dollar. So a big momentum fueled reversal on DXY. The last time that happened was August 2008. Now, that doesn't guarantee that we'll get another financial crisis, but it does mean that you should be open-minded to all outcomes, perhaps diminish some risk, because we're clearly seeing signs right now that market participants are pricing in a lot of turbulence across assets as they were back in 2008. Now let's move on to the next indicator that we're looking at in this article where we talked about the probability of a short-term correction rising. We posted this chart talking about the transportation ETF that was beginning to lag the S&P 500. So this is the S&P transportation ETF. This is the S&P 500. The S&P 500 is making a higher high, and the transportation ETF is selling off. And what's very interesting about the transportation ETF is that it's typically a leading indicator of the stock market. If transportation is weak, it means less goods and services are being exchanged, and weakness in transportation usually precedes weakness in the broad market. When you have divergence like this, where the markets are heading higher, making a higher high, and transportation is heading lower, that tends to be followed by correction. You can see that happened in 2018 crash repo market. Right here you had some divergence, led to a nice correction. And also before the COVID crisis, transportation lagged the S&P 500 in January and February. So that was the beginning of a divergence that we saw right here. But let me show you what this chart looks like right now. This is now the chart of the S&P Transportation ETF, a huge sell-off. If we add the S&P 500 on this chart, the orange line here, you can see transportation is clearly leading this sell-off, clearly building a lot of divergence between transportation and the rest of the market. So big warning signal. Again, that doesn't mean that the markets are going to tank tomorrow. It could mean that the markets are going to tank tomorrow, but it could also mean that we're going to see a recovery in transportation, see a lower low on the transportation ETF while the S&P 500 makes a higher high. Then you get some big divergence between the S&P 500 and the transportation that's going lower, and that's when you get the ultimate top. This just means that we're really starting to see a switch from a risk-on environment to a risk-off environment, and increases the risk of being long on the market. So if you're too leveraged, you have too much risk taking, take some profits off the table, increase your cash positions. That's what we're doing. We were heavily invested into the inflation trade, extremely long across assets because we've been expecting a dollar bear environment, but seeing these risk off developments appear, we're increasing our cash positions until either we see a larger sell-off where we can take advantage of opportunities, or once these warning signals begin to disappear and we're back in a risk-on environment. Now, I do want to show you one more chart that's pretty compelling, but before I do so, I just want to ask you one more time, if you haven't already, make sure to smash that like button as hard as you can. Giving out strong convictions like these is not always easy on the internet and social media. So if you appreciate it, if you appreciate this type of content and the information and research we provide, make sure to like this video and also check out our website at gameoftrades.net. We recently posted an article talking about this, talking about whether the entire macro outlook has changed. And we obviously put out a lot more content on assets like Bitcoin with detailed analysis, on-chain analysis, technical analysis, and discuss topics like whether or not the stock market is really overvalued. But now let's move on and take a look at this chart, another indicator of TLT divided by JNK. If you are a true Game of Trades fan, you will remember this video that we posted quite a while ago on the 2021 hedge. And in that video, this is exactly the ratio that we talked about, and this is exactly the development that we said we were watching out for that we're currently getting right now. So this is the ratio between high quality bonds and poor quality bonds. So when it goes down, it means investors are not very worried about insolvencies. But when this ratio breaks out and begins to rise, that's when you know that market participants are beginning to price in potential insolvencies, potential defaults. And when you see this type of development, that's another sign of the markets switching from a risk-on environment where this ratio is coming down to a risk-off environment. Same thing happened in January 2020. A big rise in TLT to JNK spread. That was a big warning signal before the COVID crisis. So that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, make sure to smash that like button and subscribe if you haven't already. Now, in the meantime, good luck on your trading and see you next time.